I think at this point, you need to look back at history. And if you take a look at prior periods that are like this, so for example, when Paul Volcker took over at the Fed and he was charged of fighting inflation, the market went down about 9% in the space of, I think, 13 days. And then it rallied 8% in the space of 16 days. And it went through this choppy back and forth until it ultimately lost about 27% before all was said and done. So I think 2 weeks from now, you're going to be sitting looking at the S&P up 3 to 5% from current levels, and everybody will be saying, oh, it's the bottom and everything's good. And the Fed hasn't even started hiking. And so you're going to continue, I think, to go through the zigzag pattern. And that's why we only have one short in the portfolio. We covered all the rest of them because we're expecting that kind of rally. And you can see this even when the tech bubble broke or in the late 60s when inflation first started to pick up. So our big thing remains the same. 20% correction in the S&P 500, at least from peak to trough, when all is said and done. Multiples contracting, the Fed being very aggressive. But you want to take advantage of periods like what you just saw to go shopping. And we bought some bank stocks. We bought another tech name that had gotten really beat up today in optical. But you need to have shorts to offset this because in a down 20% tape, everything's going to get caught up in it regardless of how good it is. Microsoft's down for the year. Apple's down for the year. We'll see how Google and Facebook do, but Google's my biggest position, single stock position. I think they're going to put up good numbers, but they're all down. So you can't escape if you have high valuations in the market.
And so let's talk about some of those mega caps you just mentioned. How significant was it that this week Microsoft and Apple both reported the numbers they did, but the market interpreted them as they did? Does it sort of stop the rot, as it were, of the 40, 50% decliners like Netflix and Peloton spreading to the mega caps?
Well, the great thing about this market right now is because people have suffered so much pain, they can't now just sort of put the blinders on and say, well, 5 years from now, it's going to be great, and so I can ignore this, which is what they were trying to do with Netflix. Because don't forget, Netflix mixed 2 subscriber numbers last year, and everybody was like, well, don't worry about it because it's going to be so much bigger 5 years from now. Then they report another miss, and everybody downgrades. So I think now you're going to go through and see people focus on things like cash flow and profits. And so more money is going to migrate to those names that can generate cash flow and profits that maybe benefit from the economy's reopening. And so I think you're absolutely right. It benefits those names. But don't forget, the ones that are beat up the most will rally the hardest off the bottom, but you're going to just continue to grind lower in those non-earnings names, whereas the big cash flow guys will hang in way better, just like they've done during prior bear markets when multiples contract.